Hello, and welcome to Buckingham's Weekly Perspectives. My name is Kevin Grogan, Managing Director of Investment Strategy here at Buckingham. In today's video, I'm going to talk about the recent uptick we've seen in market volatility, as well as the big increase in interest rates we've seen here so far in 2022. While there is a lot of bad news to cover in terms of what's happened so far this year, I do think there is a silver lining if you stick around to the end of the video. So to bring everyone up to speed as to what's happened so far this year, so far the S&P 500 is down about 10% year to date, and we've seen the yield on a 10-year Treasury note move from 1.5% at the beginning of the year up to about 2.9% as of this morning. And while that is a very big move in interest rates over the course of less than 4 months, much of this move has happened here in the month of April. So at the beginning of April, the yield on a 10-year Treasury note was just 2.3%. So we've seen that yield move up 0.6% in the course of just 3 short weeks so far here in April. And we've not seen such large rate increases over such a short period of time in many, many years. And so that's leading to lots of questions from investors about how they should be thinking about their portfolio and specifically the bond side of their portfolio. And one common question that often comes up is, well, what's driving this? Why are we seeing interest rates move so much over a short period of time? And I think most of this is due to expected changes in Federal Reserve policy. So currently, the market is pricing in a likely Fed funds rate at the end of this year of between 2.5% to 3%. And to put that number in context, when we started 2022, the Fed funds target rate was close to 0. And the first time they raised rates in many meetings was back in March of 2022. And so the market is pricing in lots of rate hikes over the balance of 2022, all the way from 0 to start the year up to 2.5% or even as high as 3% by the end of the year. And this change in policy is largely due to the Federal Reserve trying to combat the inflation that we've seen here in recent months. And so what the Federal Reserve is trying to do is make up for perhaps being a little bit slow to raising interest rates at the beginning of 2022 or even going back to late 2021. They did not begin raising interest rates until that meeting in March of 2022. And speaking of inflation, the market can also price in expectations for future inflation. And the best guess over the next 5 years in terms of the market is that inflation will be around 3.4% over the next 5 years, which is still well above the Federal Reserve's target of 2% long-term inflation. So again, even with the expected aggressive action over the course of 2022 from the Federal Reserve, the market still expects inflation to be north of where the Federal Reserve wants it to be over the long term. Another item we've observed over the course of 2022 and even going back to late 2021 is that stocks and bonds have started to become more correlated with one another over here in the recent months. And so to be clear, though, we still think that bonds can provide diversification benefit to an all-stock portfolio and can help reduce the risk or volatility level of a portfolio relative to one that is invested more in stocks. But it is certainly possible that over the next near term, say the next 1 year, 3 years, 5 years, the bonds might not provide as much diversification benefit as they have over the past 10 to 15 years. And so to sum up what I've covered so far, it's really not a lot of great news. I've said that stocks have had negative returns so far this year. I've said that bonds have had negative returns so far this year. So when rates move up, bond prices decline. And then I've also said that bonds are providing less of a diversification benefit than they have over the recent past. So then the question becomes, is there any good news? Is there any silver lining that I can share based on the current market environment? And so I think the answer is yes, that while interest rates going up is bad for bond investors here in the short term because it means the prices of the bonds they hold in their portfolio today are a bit lower, we think that this is actually good news for bond investors over the long term. So meaning that if you're holding your bonds for a longer term strategy, meaning 10, 20, 30 years, if your investment horizon is that long, that higher interest rates on net are probably a good thing for you because it means that the long-term expected return on the bond side of your portfolio is likely to be higher. So again, while it means some pain here in the short term, it's likely a positive development for your long-term investment strategy. The second thing I mentioned was, again, while it's never fun to have stocks and bonds experience negative returns in the same year, that's well within the realm of possibility for the capital market expectations that we put into our planning software. So if you have a financial plan that has incorporated what we've seen already, then there's no need to make major adjustments to your investment portfolio because it's already been incorporated in the planning that's been done by your advisor. Of course, if you do have specific questions related to your plan, you can of course reach out to your advisor or click on the link below.